All right, we have more changes unfolding in the U.S. financial system and over at the Federal Reserve. Changes that have the Fed's closely watched Senior Loan Officer Opinion Survey, the SLOOS, just dropping, and it shows more pain coming for small and mid-sized businesses, also real estate investors especially, as across the board, banks tightened lending standards again. We'll look at the report and what it means for you if you have an existing loan or need a loan in the future, if you plan on doing a refi on your mortgage, taking out a HELOC maybe, or obtaining a credit card even. All of this is relevant because the Fed asked banks this time around a special set of questions for 2024, and the vast majority answered with one word: tighter. But before we get started, thank you for liking and sharing these videos. It really helps me out. Also, make sure to subscribe to the channel so you don't miss these regular updates. So the SLOOS, the Senior Loan Officer Opinion Survey, it's like the creme de la creme for tracking what's happening in the world of lending. The Federal Reserve takes this report very seriously, especially right now, being that we're on the backside of their tightening campaign, as this report provides them a glimpse of what's happening behind the scenes at these banks. It's a survey, right, that the Fed conducts each quarter. They send out a list of questions, a questionnaire of sorts, to banks all over the country with a long list of questions focused around their lending standards, meaning, are you making it easier for borrowers to obtain a loan, or are you making it more difficult? What they're trying to understand is if said bank is willing to write new loans or not. What are the standards? Are you making the terms more difficult? All of these things. That's what they want to get to the bottom of. And everything for personal loan products like credit cards, HELOCs, all the way to commercial loans, including real estate loans, both residential and commercial real estate, everything showed up tighter. Banks are saying we're making it tighter across the board, and we think we're going to continue to do that for all of 2024. And why this is so important right now is because it's critical to the Fed's plan on how they proceed going forward. Can they begin to cut rates yet? How quickly can they do that? All of those questions, they use this report as a window to see what the consequences of those decisions could look like. As lending, it's like the backbone of the U.S. economy. If lending dries up, the economy craters. Likewise, if too many loans are written, the economy goes haywire, like what we saw during the pandemic. So here's the report. Look at this. You can see this on the Fed's website, by the way. It was just released. This is the January 2024 Senior Loan Officer Opinion Survey on banking lending practices, addressed changes in the standards and terms on and demand for bank loans in businesses and households over the past 3 months. And look at this. They say, quote, regarding loans to businesses, survey respondents on balance reported tighter standards and weaker demand for C&I loans, that's like business loans, to firms of all sizes over the fourth quarter. Furthermore, banks reported tighter standards and weaker demand for all CRE loans, commercial real estate loans. Now, before we go on, this is a big deal because we thought we saw peak tightening in Q3. This was the previous SLOOS report. We were almost as tight as we were back during the great financial crisis. And if you recall, following the meltdown of '08, banks stopped lending completely back then. There was no money changing hands back then. It's why Ben Bernanke came up with QE in the first place, quantitative easing, to get banks to start lending money again. They go on and write this for personal loans. Look at this. They say, quote, for loans to households, banks on balance reported that lending standards tightened again across all categories of residential real estate loans other than government residential mortgages and GSE eligible mortgages, for which standards remain basically unchanged. Meanwhile, demand weakened for all residential real estate loan categories. In addition, banks reported tighter standards and weaker demand for home equity lines of credit, HELOCs. Moreover, for credit card, auto, and other consumer loans, standards reportedly tightened again, and demand weakened on balance. This is not good, especially because this was the end of 2023. This is going into 2024, which is when a ton of loans are supposed to be resetting. We've already been getting reports that defaults are rising in the first few weeks of the year. For example, take corporate loans. The number of corporate loan maturities in 2024, it's scheduled to increase by 400%, 4x the number of corporate loans mature this year than they did in 2023 last year. You can see it on this chart. which means if your small business has a loan about to mature and you can't find a bank to refi, you're screwed. The same thing is happening with real estate investors, by the way. CRE loan maturities jump as well this year, which is why this report is so important and why we may have heard for the first time both Janet Yellen and Jerome Powell come out for the first time to broadcast to everyone that prices won't be coming down. Prices won't be returning to where they were, they said. Watch this.
How do you convince Americans and voters that those prices might not go back to where they were before the pandemic?
Well, I think most Americans know that prices are not likely to fall. It's not the Fed's objective to try to push the level of prices back to where they were.
Now, Jerome Powell said the same thing on 60 Minutes on Sunday, which is odd. They've never said that before, but they both come out and say the same thing in the same week. Jay Powell doing so on 60 Minutes of all places. It's like a staple for a lot of American families. They want to get the point across that they're done, folks. They need to start cutting these rates. I don't want them to, but they need to. Otherwise, they're gearing up for some big problems over the next year. For some context, we all know that the Fed started this tightening campaign almost 2 years ago now, right? Back in March 2022. That's a long time ago. They started with the Fed funds rate, the overnight rate at 0%. No joke, the night rate was literally between 0 to 0.25%, which means money was free. You could basically borrow money at zero interest. This period right here, this was right after the pandemic began and the Fed cut rates back to zero. This is when things blew right out of control with a 0% night rate, plus the federal government deciding to dump all of that stimulus money into the economy. What happened was the economy blew up right to the moon. The stock market skyrocketed to new all-time highs. Everyone had more cash in their pockets, but in order for that to happen, in order for all that money to get into circulation, banks had to lend it. As money's created when banks write new loans, or in other cases, like when it came to forbearances, when tens of millions of mortgage holders were allowed to just not pay their mortgage for 12 months or for like 18 months or whatever it was. Think about that, though. Think about all the money that regular people were able to save. That added a lot of bloat to the system, as those loans weren't being paid off anymore. The money was going into the pockets of consumers instead. All of this happened during this period, 2020 to 2022. Not to mention banks also had loosened their lending standards. Anyone and everyone could basically get a loan. And who wouldn't do that? You're borrowing at 0% interest. It's free money for all intents and purposes. We saw financial markets bubble up, the stock market, crypto market, all financial assets were just ballooning in value. We also saw the housing market bubble up. Commercial real estate market bubbled up. I saw this personally at Snapforce. We had hundreds of mortgage companies and debt shops using our CRM and growing. They were growing fast, constantly adding new loan officers. It was amazing. Until things, though, got so hot, the bubble got so large, banks had written too many loans, too much money was dumped into play. Everything began bubbling up, including inflation, the dirtiest word in economics, bubbling up to 9%, which means prices overall, according to government data, were increasing at 9% per year. So the Fed stepped in, obviously, and almost 2 years ago now, in March 2022, began this tightening campaign, incrementally hiking the night rate to slow the economy, slow the rate of inflation, which you could see on this chart. Fastest hiking campaign in history. But that wasn't the only thing that they did. Rate hikes were only half of their plan. They also had QT, and they were also relying on the banks to stop lending, the most potent of all tools in their toolbox. Lending is what makes the world go round, and right now, banks aren't lending. This new SLOOS confirms that. They've stepped back in a big way, which means if you're a small business with a loan that's getting ready to mature, what do you do if you can't refinance? Or if you do find a bank willing to work with you, but they make the terms so unreasonable it squeezes you out of business, what happens? It's a slow grind down is what it is until the economy just craters. Businesses can hold on for a while. I know in my case, I wouldn't close my business just because my rate doubled. I would do whatever I could to make it work. I'd start cutting costs, lay off employees, do what you have to do. I do all of that and more before failing, which is exactly what's happening right now. Listen to this small business owner explain how tight of a spot he's in at the moment because no bank's willing to write a loan. I played this a few weeks ago, but it's worth watching again. Watch this.
We're recovering really well. We'll be within probably 30% of pre-pandemic numbers by the end of the year. So the business is doing well. The business is healthy, great reputation. And yet nobody will give me a loan on the building. And the one person that did make me the loan offer, the rate was so high and the terms were so bad. I mean, I was grateful to get the offer, but I would be out of business in 6-7 months because the interest is so high. It's an interest-only loan, and my payments would more than double, almost triple from what they are now. And so it would take, well, right now I'm doing what, $800,000 a year in revenue, and it would take most of that revenue just to make the building payments. I wouldn't be able to pay my staff, my vendors, anything. So, if the interest rates are high, nobody wants to make a reasonable loan, despite the fact that I have impeccable credit and a really good business and a lot of equity in the building. But it's like they don't care about those things that they've always cared about anymore. So I'm a little bit lost as to what to do, and I'm running out of time.
Now, Mark, a lot of people are in the same shoes as you are.
Yeah.
There's
Worse, I'm sure.
$2 billion of loans coming due this year, and then there's another $2 billion that they need to get refinanced next year in San Francisco.
Yeah.
Bottom line, the Fed is done, folks. They have no choice but to start cutting rates. I think we'll see the first cut sooner than later. That wraps up this episode. Like, subscribe, and we'll see you next time.